Hi, this is Stephen Ertel with Concinnus Financial. Thanks for joining me again. Today I'm going to be presenting on opportunities in emerging markets. For those that might not be familiar, I figured we better introduce what the emerging markets are and then go over some common characteristics of these emerging economies. We'll start with the BRICS nations, most commonly quoted: Brazil, Russia, India, China, and South Africa, including Mexico, Philippines, Vietnam, and now the next 11, which includes Bangladesh, Malaysia, etc. We're looking at a group of over 60 countries included in emerging markets. So some common characteristics of these emerging economies are most are transitioning from a command economy or a government-led, government-directed to a more free market-driven, and this really serves to underpin economic growth going forward. Also, most are characterized by having a growing middle class, more favorable demographic picture, and generally a lot more of their population concentrated in the working age group. Also, they must have improving social stability and living standards. And as a whole, these countries comprise over 60% of the world's population and nearly 50% of global GDP. Most are export dependent, so sensitive to commodities prices, as we've seen over the last few years. Common theme is ever increasing levels of technology and connectivity. These are societies which are becoming more stable, and information is beginning to flow more and more freely. Now I want to take a look at specific risk factors with investing in emerging markets. Number one, we'll look at political and geopolitical risks. So commonly, there's a bureaucracy and corruption element. These can be inefficiencies in the way these countries are operating that we might not be accustomed to here, and an elevated risk of, say, civil unrest. And as I mentioned in the last slide, we do have improving social stability in these countries. However, once again, a more elevated risk than developed economies. And I also list Russia and the Crimea situation to highlight geopolitical risk. There are uncertainties as to what these governments and what their leaders would do. That's something that investors can't necessarily prepare for or try to predict. Also, emerging markets are sensitive to currency risk. And when I say currency risk, I'm primarily referring to depreciation of these emerging currencies against the US dollar. I'll go into more detail on that later. And just general volatility. Stocks tend to be more volatile in emerging markets. These exchanges don't necessarily have the liquidity and volume that we have here in developed markets. And also the information about some of these companies is not as easily found or as plentiful as it is for, say, a large cap U.S. company. And I'd like to go over some countries where we see the opportunities specifically. Number one, India. They have a fantastic demographics picture, and this is kind of the ground level driver of economic growth. They're set to exceed the population of China in 6 or 7 years, and at that time, the median age in India will be 29 years old, with 65% of their population aged under 35. That's a significant number of young adults entering the workforce that is going to drive their economy going forward. India is also the world's fastest growing economy at this time, around about 7% annual GDP growth. And over the last several years, as India's government has liberalized their economy and made it easier for foreign investors to bring capital into their country, we see India now the number one recipient of greenfield foreign direct investment. So these are outside firms investing in new projects within India. Also, what I like to refer to as the low-hanging fruit, India's infrastructure is in serious need of improving and building out. As we saw in China, going back 20, 30 years, we saw their government really push infrastructure build out. And this is something that the government can lead. And also manufacturing is another area of opportunity, low-hanging fruit for India. We're actually seeing Chinese companies now investing in India, actually outsourcing their labor needs to India at this point as Chinese wages have increased over the years. Other nations that we see opportunity: South Africa, Taiwan, although not really considered an emerging economy, and Thailand as well. What I like about these economies is they're diversified. They have diversified businesses, they have diversified economies, so they're not going to be overly sensitive to any one sector or commodity taking a hit. And in my next slide, I have a chart here of EEM. It's an iShares Emerging Markets ETF. And I just wanted to illustrate, we're looking at 2006 level of pricing. I'm all about using time to our advantage. Had we invested in 2006, 2007, or most of 2008, we would still be in the red, 10, 9, 8 years later. So I'm all about erasing that decade and investing now where, especially in real terms, emerging markets can represent a tremendous value for investors that are willing to take on those emerging market risks. And as I mentioned earlier, I was going to revisit the US dollar because this is an important aspect of investing in emerging markets. Number one, emerging markets and companies within them often borrow in US dollars. So as their local currencies depreciate against the dollar, it makes it harder and harder for them to repay those dollar-denominated debts. Also, for investors here in the US, as we invest in emerging markets, we're essentially exchanging our US dollars for those local currencies. Then when we go to sell, we're trying to convert those local currencies back into US dollars. If the dollar has appreciated, then we're going to take a haircut on any capital gains that we would have had. But on the flip side of the coin, if the dollar was to depreciate against those local currencies, we would see an added benefit to our investment. And third, as I mentioned earlier, emerging markets are primarily export-driven economies and therefore much more sensitive to commodity prices. Most commodities are priced in US dollars, so as the US dollar strengthens, commodity prices come down, and that hurts emerging markets. However, if the US dollar was to depreciate, that serves to bump up commodity prices and also buoy emerging markets at the same time. And I'll wrap up my presentation here. Once again, thanks for joining me. My name is Stephen Ertel with Concinnus Financial. We're a local, independent investment advisor in Spokane, Washington. We're trying to put out good information that you guys can use in these presentations. You can expect these roughly once per month, or if you're in the Spokane area, we do these presentations at our offices, address listed below. Thanks for joining us. I hope you'll tune in next time. Thank you.